So we've seen dwelling values on the CoreLogic measure up 1.7% in April. So a pretty big jump when you consider January, February, March was all positive. We're all seeing rises across the capital city index across those months, but April is quite a bit stronger. So this is the fourth straight month where we've seen values rising after a fairly weak December quarter where we saw values fall by about 2%. What we're seeing at the moment, though, is still some very, very different conditions across the different cities. We're still seeing Perth and Darwin down on an annual basis, Darwin more so than Perth. But we are starting to see some signs that maybe those markets are levelling out. We've seen a couple of months of growth now, and it looks like the annual trend has turned a little bit. In the same sense, the other capital cities, we're seeing the smaller cities like Brisbane, Canberra, Hobart, showing some level of momentum gathering now. These are cities that are generally more affordable, they're fairly early in the growth cycle. And then you've got areas like Sydney and Melbourne, which are still showing very strong, solid growth, but we're starting to see that growth easing now. So just values are still rising, but not as fast as what they used to be. The settlement risk is essentially the risk that off-the-plan apartment sales, which have, say, a 2-year horizon for settlement, at the time of settlement, the valuation comes in lower than the contract price. And that has a whole bunch of ramifications. Simply means that buyers may need to top up their deposits in order to meet their loan to valuation requirements. It may mean that more people try to remove themselves from their contracts if they can. Contracts tend to be pretty tight. For overseas buyers, that tends to be a little bit easier because it's harder to track them down overseas. So there's imperative, relative to that, there's then risk for developers and also for the lenders to those developers as well, that more people will remove themselves from their contracts. Worst case scenario, negative gearing is removed entirely. I think that's going to have a big effect on investor demand. As you say, rental yields are very low. Most investors will be utilising a negative gearing strategy, particularly in Sydney and Melbourne, where yields have just moved back to new record lows. Melbourne's around 2.9% gross. Sydney's about 3% gross. So I think we won't see negative gearing removed entirely. The Labor policy is to divert negative gearing purely to new properties. I think that's still going to be a major disincentive to investors simply because a lot of investors aren't willing to buy a new product. You can see that in the housing finance data that suggests 93% of investors are buying established homes. So what are some of the reasons why they're not buying new? Probably comes down to a risk of buying off the plan. A lot of off the plan product is in areas where supply can move unhealthily high, as we're seeing in some intercity apartment markets. But we're also seeing, investors looking at long-term view, and if they do buy a new product now, what if they want to sell it to another investor down the track? Because it's now then an established or a second-hand product, they won't be able to sell it to an investor who's looking to negative gear. So that secondary phase of demand will be diminished quite substantially.